Hello and welcome to our latest webinar, Effective Strategies for Mastering Your 2025 Association Budget. Today, we'll be talking about a very important and timely topic, budgeting for the upcoming year. Now, this budget season is unlike anything we've ever seen before. New state regulations around reserve funds and inspections in Florida, combined with rising insurance and labor costs and inflation, are presenting new challenges when budgeting. Budgeting in these times comes with a lot of uncomfortable realities, but there is light at the end of the tunnel. Now, how do we get there? My name is An Nguyen, and I'm a vice president at First Service Residential, and I will be moderating today's webinar. We have a few housekeeping items before I introduce our panel and get into the discussion. First of all, if you have any questions throughout the webinar, please submit them through the Q&A option on your control panel. If we don't have the opportunity to address all of your questions, we'll be sure to have someone from our local team follow up with you. Secondly, there's no need to take notes today. We'll be recording the session and sending a link to all attendees. And then finally, we'll be posting a link to our budget checklist in the chat in the next few minutes. You may want to bookmark it for future reference. We've gotten some great feedback from both new and seasoned board members that this has been really helpful to them. So we've got a great program for you today, and let's get started. Let's dive right in. Joining me are two experts from First Service Residential, Brent Reynolds, Vice President. Welcome, Brent.
Hello, An.
Good to have you, sir. And then Amy Sanchez, President of Central Florida. Hi, Amy.
Hi, An. Happy to be here today.
All right, so let's get started. Brent, can you tell me what you're hearing from our managers and board members as they prepare for this budget season?
Hey, An, thanks for agreeing to moderate clearly what is a very important topic. And certainly what we hear everywhere is that everybody is keenly aware and thinking a lot about their 2025 budget. I think sentiment varies based upon a couple different factors, right? Your perspective, that is, where you're located. We're obviously talking here to all of the South region, so lots of representation here. So people are feeling and seeing things here in Florida that might be a little bit different than Georgia, Alabama, and Tennessee. I think another thing that's of big importance is from a perspective is what type of community. Certainly there are new challenges facing condominium associations that differ considerably from where homeowners associations are at the time. And then getting kind of more local, okay, what's the condition of the community? As we see new legislation taking place in lots of areas, communities having to take a look at current condition and what their spends are in the near future. And likewise, what kind of decisions were made in the past by past boards? How did they budget, and what decisions were made on how to upkeep those assets? And then I think I hear a lot of people talking about wages, right? Can our wages keeping up with what kind of increases we're seeing and just general inflationary cost as well as association business? But look, what we want boards and as well as our operating teams to hear is that there's really no reason to fear rising cost. It's a reality of associations, and it's just something to be addressed head on. We do know that wages are moving alongside of inflation, and we'll spend a little bit of time later on talking about those wages. But what we want those to hear today is that most owners expect these costs to be going up, right? They expect homeowner association costs, their dues to go up, but they also expect good stewardship of those dollars, and they want to be kept in the know as to what's driving those costs. And so a lot of what we'll talk about today, the real magic comes to transparency and communication all throughout the budgeting process.
Great stuff. Thank you. Amy, you want to add something?
I do, thank you. Yeah, to build, Brent, onto what you were sharing, we do hear quite a bit of curiosities and statements around, hey, my boards can't afford to keep up with the rising costs. And I think a big piece of why you're mentioning wages is because the reality is that we recognize that homeowner wages are also increasing throughout the South, right? Even if you're on fixed income, right? So those who are on Social Security have seen wages continue to increase and keep pace with inflation. Inflation's gone up roughly 18 18% over the last 3 years. And so even fixed incomes have kept pace with that. And so while we've seen costs go up, we've seen homeowner incomes also rise alongside that, that should be able to keep pace with the costs that we're seeing happening. And of course, I know that we'll get into on some more of the specifics, I imagine, on that, but I think it's important to really, for those dialing in, to understand that piece.
So don't fear rising costs. Easier said than done. I think we'll get into the details of how to do that a little bit more. Amy, so before we talk about major factors to consider when preparing for the 2025 budget, can you give us a general outline for timing and what boards and their property management teams should be focused on now?
Yeah, very meaty question, because obviously there's a lot that goes into budget process. A couple of things that's important for those to know is, first and foremost, our organization being part of First Service Residential, we really pride ourselves on starting this process early. We typically look at it as about a 6-month long process. So it's good timing for us to be kicking off this conversation. I'd also say that today we're going to be talking in generalities. Most of our communities that we manage run on a fiscal year of January through December, though it's important to note that your community might be a little bit different. So if you run on a fiscal year that runs, June to May or something along those lines, your timeline might look a little different. Today, we're going to be talking specifically to those that run traditional fiscal year, January through December. So with that being said, I'd also say that while we're getting into some specifics here, you mentioned it earlier, there's going to be a deck that goes out and is shared in the chat so that if you're dialing in, you don't have to take notes, but this is just generally for conversation purposes. So we're in July, which means that we're really at the start of this process, and June financials are going to be coming out. And as June financials come out, those should really serve as the baseline for planning as we go into this budget season. And you're going to be using those as well as using this time to call vendors, key vendors that might not have contracted rates already set for 25, those that are either on month to month or you don't have a service contract in place for. Managers should be calling those key vendors and saying, hey, what is the cost outlook for 2025 for your products look like? What do we need to prepare for and plan for? What can we expect? And I'm sure we'll get into some of the major components here, but this is the time frame to really be talking with your community specific vendors for planning purposes for drafting that budget. As we move into August, really, you're going to want your draft budgets starting to be penciled out, and you're going to be planning for what your workshops are going to be looking like if you host workshops in your community in the September timeframe. I'll get into October here in just a minute, but I think it's important to step back and say that today, if you haven't done so already, you should be speccing out your timeline in general to hit the major milestones throughout the budget process so that you got them planned out and you know what are those key pieces so that you make sure that you stay on track to be able to deliver a budget on time for your community. You don't want to roll into the next year and not have that already done. So going back to our timeline today, timeline should be specced out. You should have that ironed out, know those key dates and milestones. Drafting your budget in July and August, workshops in September if you host those. And then ultimately you're going to be sending your mailings out for your budget adoption. Those should go out in September for adoption meetings to be held in October. And you're communicating through to your homeowners and your board members throughout this process, so everyone knows the budget that's going to be shared, everyone's on board, you've answered questions in advance, and have a general sentiment that come October budget meeting, that those will be accepted and adopted, and you can get those submitted in the early weeks in November, so that from there you can communicate to homeowners, hey, this is your new assessment for 2025. This has been adopted. Please update your bank accounts and things like that. And then that really needs to be wrapped up by November. I will tell you, we hear from time to time, and Brent, I know you and I have talked about this, that some communities like to hold out until they know their exact costs for things. So maybe they'll try to push that into end of November or December. That's a bit of risky business. It doesn't give homeowners a lot of time to plan, doesn't give the team a lot of time to make sure that accounts are updated and that homeowners can be informed. So would really encourage everyone to, you can find out that information early. You don't have to wait for utility providers, for example, to share what their new rates are, to estimate what that is going to be, fold that into your budget and be able to plan accordingly. A lot of data there on.
Yeah, that's great. And we've also just dropped a comprehensive budget timeline in the chat for your review. So look that over. What I've often done is when educating our board members and managers and preparing for the budget is I've told them begin with the end in mind. So start with the end date. What is the date that you're going to adopt the budget, and then work backwards to each milestone date that needs to be met before you adopt the budget. So great stuff there, Amy. All right, Brent, now that we have an idea around timing, let's dive into the major components of the budget and what communities can expect. Starting first with labor. What are we seeing with wages, and how do we see this impacting association budgets?
Yeah, great question on, look, there's no doubt that costs are going up for all Americans, right? Now there's variability, right? So while Georgia, Tennessee, Alabama haven't maybe seen quite the same in wage increase as we have in Florida, wages certainly have increased, and it's driving cost all along with it, right, along the way. So it's a two-way street. So while income is on the incline for many, the ability to pay for more is being cut by other rising costs that are out there. Getting a little bit more specific, major metro areas, right? And if I talk here maybe a little bit more specifically in Florida as a baseline, minimum wage is going up. We're going to see a next dollar climb in September of this year to $13 as a minimum. And therefore, we think that we'll see wages in the 25 budgets move that $1 per hour for hourly roles, and expecting by probably 4 to 5% increase for all salary positions. So we should note that it may be greater for communities that have underfunded their annual year-over-year increases. Can't overemphasize this enough. I'll hear a lot of people say, well, we're already paying way above the minimum wage, so this isn't going to impact us. And in a market like we are today, where there's still extremely low unemployment, we get the compression effect, right? So as the minimum wage comes up, that'll push more and more wages as people are seeking to increase their income. So it's not something that we can skirt and just bury our head in the sand on. We do need to budget for increases as we go into 25. You're going to want to do that very thoughtfully, right? Taking a look at roles where you are specifically, and again, that may vary state by state. And if you got a good property management partner, they've already provided you with that kind of wage data. We take a look across here at First Service Residential. We're looking across a huge set of data in all of the communities we manage. And so we're able to take very thoughtful approaches to what is the pay range that we should be looking at in these submarkets. And Amy mentioned something earlier. Probably what I hear most often is we can't let assessments go up. We have too many people on fixed income, and this is going to cripple them. It's already gone up so much over the past couple of years. To Amy's point, Social Security has kept pace with the Consumer Price Index. So this year alone, we're going to see a 3.2% increase in Social Security benefit. Last year was 8.7, the year before 5.9. So there's been 18% increase in the past 3 years. I don't mean to minimize the impact and how people on fixed income are living, because they're also seeing other costs increase. Just wanted to dispel a myth that that we're far exceeding wage increases, and that just really has not been factual.
Right, just to add on to that, from a wage perspective, it's important to note that this is still a plan, right? So this is a forecasted plan, and making sure that you've got the right wages, and that our management team is maybe working with their HR partner, their local leadership team, to ensure that wages are set appropriately. Even if you've got somebody today who's at a lower or below market rate, making sure that you're planning for that, because in case anything happens to that individual, maybe they get another opportunity, they move on, they win the lottery, right? Having to backfill is going to be something that will come into play in the new year. And if you've got a rate set aside that's far below market rate, it will be really tough to attract the right talent to meet the community's needs as you go forward. So again, plan doesn't,
Yeah.
mean that you give that right away, but it does make sure that you have sufficient to attract what you need.
Yeah, that's sage advice, Amy. I think I'll hear some boards that'll say, well, no, we're not going to budget for an increase because, that's the way we're going to control your cost, right? And control the management company from going up. Look, responsible property management companies use like First Service Residential, we use a pay for performance model, right? We use a rigorous merit-based approval process. We do performance reviews. That performance is what drives percentage increases. We look at what those increases need to be on a year-by-year basis based upon what we do see happening with inflation. So best advice that we could give to associations and boards and say, look, give your manager a fighting chance. Budget 4 to 5% at a minimum of increase in payroll overall. Trust your manager then, have the conversation, but trust your manager to actually work within those confines. Again, to Amy's point, that doesn't mean we're going to give out 4 to 5% increase necessarily, but it gives that manager the tools to be competitive in these metro markets. It's been street fighter marketing, right, to try to attract best talent in. And unfortunately, what we see, while people maybe stayed in there because they've got a good manager, at some point about a 20% difference in a wage somewhere else is going to drive somebody to make that change. And then you're stuck with trying to backfill in a market that won't handle the rate that we've been paying historically. So it's all about sourcing and really thinking through, but sit with your property manager and really have a good conversation around what is needed to be budgeted as we go into this year so that you've got the best talent at the helm.
Yeah, the old adage remains true, doesn't it? You get what you pay for, and certainly holds true for wages and salaries. If you don't pay your people a competitive wage, then don't be surprised if you have high turnover on your staff.
We talk about that a lot right? Price is what we pay, value is what we get as the result of the decisions we make. And in a tight labor market, this isn't the time to be trying to skimp on that one in order to make the budget work.
Yeah, for sure. All right, Amy. So let's talk about legislative changes. As many know, communities throughout Florida are rethinking their reserve funding strategies because of recent legislative changes. Some communities are underfunded and need to catch up. What can boards do in the wake of these changes?
So a couple of things before I answer that question. First and foremost, well, a lot of this, again, I know we're talking a lot about Florida. Florida obviously had some big shifts, not only in wages, but legislative updates that have happened, which is why we're talking about that. But I do think that even if you're out of the Florida market and in Georgia, Tennessee, or Alabama, those states do need to pay close attention because we've seen what's happened here permeate into those other markets. So you still want to be paying attention and dialing in here. The main one, lots of legislative changes. The main one on that you're asking about specifically has been the change to reserve studies and what communities can set aside. And we're going to talk about that one specifically because it is likely going to impact your association budget the most as you plan for 25. So for those of you who don't know, what has changed is that the spirit behind it is that communities can no longer bypass structural reserve funding. So historically, communities have either by majority vote been able to say, hey, we're going to defer that cost. We don't really need to set aside that money. And following the Surfside collapse, Florida legislature came together and said, no more. There cannot be an avoidance of setting aside the proper amount of money for structural investments for the community to keep pace with what it needs to avoid catastrophic issues. So managers over the past year and a half, 2 years have spent considerable time updating their reserve studies to understand what is a structural component that cannot be avoided. Communities will need to right size if they have not been setting aside the appropriate money to do so. And so what I would say at this point, because now we're going to get really community by community from a, hey, has your community been setting aside the appropriate funds? Or if it hasn't, it might be in a catch-up mode. But the most important advice here might sound simplistic, but it's really to do what's right. The government has come in and said, okay, you've avoided it. You can no longer avoid it. You now must do what's right. Our advice would be do what's right on the structural components and do what's right on the other reserve pieces too, right? Like if your reserve study says you should set aside this money, provided that it was done right and well, it needs to, our advice would be to follow that, right? Particularly if you're in a board position, that's the best way to say, hey, I'm taking the advice of an expert. This expert put together my reserve study, and this is the money that we're going to set aside. At least start there as you build your budget, because then you can have communications with homeowners for why, what's driving costs, what's going to shift and what to expect, what the community is preparing for. And most people can understand, comprehend what's happening through communication, education, and training. So to go back and answer your question, the advice would be to make sure that you're not avoiding setting aside the appropriate funds. If you're a manager, make sure that you are incorporating what your reserve study says to incorporate. Don't start there as your basis point and plan for that, would be the advice.
Hey, Amy, I'd like to add on there, so I think the great news is with our boots on the ground and as I've been out talking to boards, the exciting news is we see much better informed board members joining boards, right? People with a real understanding of a fiduciary responsibility to the association, which is a long-term responsibility, right? The decisions we make in any given budget year play forward many, many, many years, and the decisions we make will be felt further down the line. I think what we also see is rising expectations of residents, right? Of which they're looking for their home value to continue to increase. And the more informed they become, they realize that investment, not cost of an assessment, but the investment of their assessment into their association is key to driving long-term property values and driving real generational wealth within their family. So as much as we still hear, hey, we got to keep assessments low, I think the shifting tide here is really getting to understand this. And it's really to understand and appreciate the beauty of association. I'll probably get spears thrown at me, right? And from some folks, but if we stop and think about it, the whole design around an association and specifically around reserves is to make investments, small investments over time, so that when the big capital expenditures need to happen, it's an unemotional decision to be made. The roof needs replaced. We've been setting money aside in our Christmas account here for many years. We have the money. We're going to fix the roof, keeps everything dry, keeps the building in good health over the long run. It's time to paint and the exterior coating, same decisions like that. And so while it may be tempting, and it has been in years past for boards to make that short-term decision to say, well, we've had one, insurance cost has gone up this year, so we need to pay for that somehow. Let's not fund reserves. And as we started out this whole conversation, those are the ones that probably have some of the biggest heartburn today, trying to figure out how to fix things that now are well past their useful life, where they don't have the reserves to do it and still facing other rising costs and having to grapple with that. So I think your words are sage, right? Do the right thing and remove so much of the emotion around what is time when it comes to maintaining a property, and homeowner values continue to rise as they would expect them to.
You bring up a good point, Brent, that some people would look to say, hey, we've got to give up here to be able to pay this, that type of thing. You also hear, hey, we're going to deal with that if it comes via special assessment. And what we've seen in those situations is that creates far more anxiety for homeowner population that might not be able to cover special assessments that get levied, that need to plan, more accordingly, as opposed to getting hit with that big dollar sum. So largely special assessments are an option that communities could use, but it shouldn't be used as the means to pay for basic annual costs, right? Those are, hey, this is an unplanned, unforeseeable expense, right? Yeah. But if we can see it, you want to avoid finding yourself in a situation where you're just having to pay annual costs that way. Very dangerous.
Can't be overstated.
Yeah. All right, so let's tackle another big topic, and that is insurance. There is no doubt that associations are paying more for insurance. How are communities tackling this? Do you see, or do you have any best practices to share? And is there any hope for a correction in the market? Brent, let's start with you.
Yep. So this is the hot potato, right? Everybody wants to know after several years now, double-digit increases, what are we looking at for 2025? It's a little bit early yet. So we're all maybe reading the tea leaves. I do try to personally keep up on the news and see what we're seeing happening in the field. What are some of the major brokers starting to say? Look, one thing we can say that we do see happening is insurance and the legislature, at least in Florida, the state legislature, and the differences that they've made in some recent legislation as recent as 2022 that really took a stick to frivolous lawsuits. That, in addition to some really major storm and catastrophic situations in 2021, 22. That's what really drove costs up and drove a lot of the insurers out of the market. So for Florida specifically, right, we just don't have enough competition and looking to bring them back in. So that legislation on lawsuits has definitely helped. We are starting to see now carriers come back into the Florida market. And so the good news is, while we're not, I don't think anybody's ready to project reductions in insurance. Certainly the double-digit increases we've seen historically, that's not what we're seeing to happen so far going into 2025. A couple quick news pieces that were fairly recent at the beginning of July. There were quite a few, again, in the state of Florida, carriers that you have to register and you have to apply for increases in insurance. Likewise, they have to apply for decreases that are going to happen. And we saw 13 carriers file for reductions in the state of Florida, of which 3 of those have been approved by the state of Florida. The others are still in consideration. Sorry, forgive me, there were 9 that had filed for reductions, 3 approved, 6 more have applied, including Heritage and US Coastal, which from our experience, those are 2 pretty big carriers in the association business. They've applied for decreases, and 10 more carriers have filed for no change, so to be flat going into 2025. So it doesn't speak to everything, and your mileage may vary in your local market and by state and conditions of your community. I think it's definitely maybe a bellwether to say that maybe we're seeing some of the big stuff, the big increases over the past couple of years now be mitigated. We from time to time we'll hear associations that just say, look, we've got so many other things going on in the community. Again, how do we maybe rob Peter to pay Paul? Maybe we can look at maybe reducing our insurance coverage in 2025. Maybe we can increase our deductibles. Coupled with all of the other challenges that associations face, you will never hear FirstService Residential calling that a good decision. Taking on that risk is huge, and maybe even plays into additional risks that we see board members taking on as legislation all across the country tightens down to continue to hold board members accountable to their fiduciary. That is not one that we would recommend taking on that additional risk. And I think the other thing that they're doing, on to answer your question, is what we see the best communities and the smartest ones doing is need to understand how to mitigate risk, right? Insurance is risk transferal, and you're going to pay for whatever risk you're transferring to the insurance company. What can you do to reduce risk, right? What are some high risk issues, around property management, sidewalks needing repair, unsafe playgrounds, other things like that that could really put the association in hot water. That really can be handled and can be mitigated. And many insurance brokers and carriers themselves will come out and actually walk the property with the board members and with the management company and help to identify those items and really kind of building a case that says, hey, we're very thoughtful about risk. We want to be good partners with the insurance company, and anything you can do to do that. So I think overall, it's looking to mitigate and having regular communication to avoid surprises. The more we learn about insurance over time should be part of that cadence that Amy talked about earlier of working throughout the entire budget process, is sharing that information. Information and informed residents are much more understanding of than how a budget's built, what are the factors that are driving it, and is just such a great way to educate the residents and the members of the association as a whole.
And I think it's important for everyone tuning in to know that every association should have multiple policies in place. So they're going to have a policy for property. They're going to have a policy for general liability. They're going to have D&O. They're going to have workers' comp for their volunteers and so on and so forth. And so they're going to have multiple policies in place. The major cost drivers, of course, are on the property and the GL side. And Brent, a big piece of what you were talking about, where we've seen more providers come into the marketplace, have been around the property side. At the same time, the cost for repairs are going up. And so we do want more providers in the marketplace. Huge gratitude to the legislature who've enacted policies to help encourage more providers coming into the marketplace. But that might be hedged by other policies too. And so if you hear anything when it comes to the topic of insurance, the advice would be, because there's so many variables in this space, to please talk with your local agent, have your manager talk with your local agent to gauge a forecast for what's going to happen for next year. We are, generally speaking, not expecting the massive increases that we've seen. There might be a little cooling. That's not to say that you're not going to still see double-digit increases, but just maybe not the 200% increases that we were seeing. So work with your local agent to find what that's going to look like for planning purposes for 25. We do expect to see a little bit of cooling to happen, but certainly you want to make sure that you're achieving that while still retaining proper coverage. You or I do not want to be a board member that has to answer to why we had insufficient coverage in the event of a claim. So you definitely don't want to go that route.
Great stuff there. So far we've addressed major topics during budget season, including general preparation efforts, labor costs, reserve funding, and insurance. What I'd like to move us towards now is, where can boards safely consider cutting costs? What items should boards look at first? So Amy, you want to start us off here?
Yeah, happy to. So I think it's important for people to first understand that associations are nonprofit. They're not for profit, right? And really the concept is that these are zero balance budgets. So really your managers are budgeting whatever we're expecting the true cost to be. That's what's being budgeted. There's really not a lot of filler space in these budgets. And so what I would suggest doing as you start to look at what are the true costs of what you're planning, take a look to see the bulk of that should be necessity for costs, right? What are your association minimum needs for operating? You need to have insurance. You must have your utilities covered. You've got to have your management and labor included in there for it to operate, right? What are those baselines? That really takes up the vast majority of costs and expense. Of course, your primary vendors, including security and landscape and things like that. That's what's needed to make sure that your community is operating as your homeowners are expecting. Then I would take another look at, okay, what are our homeowners expecting of us, right? Do they expect beautiful annuals as we come in? Do they expect a great holiday party for 4th of July over the summertime? Are those things that homeowners have come to expect as part of their association dues? Once you capture minimum requirements and what homeowner expectations are, then take a look at what do you have left over from that. And then from there, you can say, okay, maybe there's opportunity here. My guess is that most of the time, since these are zero balance budgets, there's not really a ton of opportunity on that end. The other side of that equation is to look at how can we leverage size and scale to ensure that we're getting the best costs for what we are major services that we're using. So when we purchase supplies and goods, are we part of a procurement team? Meaning, do we have our supplies going through a bulk purchasing program so that we can get best costs? That's certainly something that First Service Residential brings to the table to ensure that our clients can take advantage of our size to get best products and services at a size that takes advantage of thousands of associations under management. So I would go through it that route and then take a look at taking advantage of size and scale before reducing costs. Keep in mind, homeowners have an expectation, and more often than not, they rarely feel comfortable going back in service. So you're going to want to keep that in mind. And then, of course, you can always send out homeowner surveys and get a true temperature reading for your homeowners once you identify the specifics of where there are opportunities to take advantage of cost savings.
Yeah, Amy, I appreciate the words you say. The question was about where could we consider cutting costs? And if you think about, and I challenge the board members out there to think that even though you may understand the basics of what goes into an association budget, many residents wouldn't understand this. This is not something that they've studied, that they've had a lot of experience around. And there's really only a handful, right? A very small, finite number of major costs that go into an association budget. And all of those are practical and are pretty easy to understand within themselves, right? Landscaping in an HOA is driven by people, the cost of labor. And we talked earlier about wages going up. And so we can expect the fact that the landscaper is going to need to charge a little bit more money in order to keep people employed. Insurance costs, we've already talked that ad nauseum, right? Why that's gone up. Those are all things, and throughout the process, educating, right? Having those conversations and putting it into simple to understand terms, helping people to understand that, okay, here's how we're building up the budget. And these are all very practical costs that are likely to go up year on year. There's very little of anything that I can even think of in which costs are ever going to go down. This is nature, right? This is how things are going to progress in a business. Amy, I think the one other thing to consider, and I do see a lot of boards miss this, is losing sight of their operating fund and realizing that when you're budgeting, you have to also be thinking about how much cash do we have on hand at any given point. Great rule of thumb should be a minimum of 2 months, and really 3 months would be preferred of the amount of cash at any given time that the association holds on to. And over time with inflation, we've seen that operating fund kind of dwindle to the point where managers are struggling sometimes to make payments within a given month based upon seasonality of some of the costs that they have. So a little bit probably too heady to get into here in this conversation, but really taking a look and saying cash on hand, are we budgeting for that? And that may mean you need to bump the assessments a little bit more to build an operating fund back up so that the manager and the association has enough money to meet current obligations. And those are in front of them, especially if there's any type of hiccups that happen throughout the course of the year that maybe, again, weren't foreseen.
Well, what would you recommend as the amount of cash on hand that an association should have?
Yeah, great question. So when I say 2 to 3 months, what I mean is whatever the association's expected expenses, cash outlays that need to happen within perhaps an average throughout the year, whatever that cost is, right, that would need to be paid out, that the operating fund has 2 to 3 months worth of that on hand in the bank. Again, that's not money being spent, right? It's not going to be in the budget per se. That's on the balance sheet. But it gives you that cushion to be able to meet all of those immediate obligations in front of the association without finding yourself having to now pay in greater than 30 days or not having money to meet those obligations. Great question, on.
Definitely hearing a theme as we go through these questions, and the theme is communicating and educating homeowners, isn't it? And that's how we get through these difficult budgeting issues and raising dues. All right, so Brent, what about revenue? Many board members don't think of this as a means of optimizing their budget. Obviously, assessments are the primary funding for any association, but what else can boards do to generate income?
Yeah, that's a great question. So depending on the type of an association and the types of amenities and the space that you have available, this could be a pretty wide-ranging answer. I think something that every association can take advantage of regardless of size and your amenity core would be putting your cash to work for you. One of the most quantifiable values that First Service Residential brings to its clients is its ability to help manage cash reserves and get them invested with partner banks who bring preferred rates because of size and scale. We've seen associations make tens of thousands of dollars more in annual income, right, off of interest on the money that they're using. So that's something that any association can benefit from. And if you're not doing that today, is certainly one of the most immediate things you can do. No, we've got a lot of smart people too that sit on boards that are already perhaps investing the association's money in CDs and money market. Would encourage you to have your manager also run cash management through our assessment to see if there's opportunities to improve that. After that, another thing that most associations could be able to do would be looking at vendor programs like bulk cable, taking an association to a negotiated term of having a bulk cable agreement, meaning everybody in the association switches to that provider, helps in two ways. One of which most of those agreements is the one for service that we bring to our clients. It brings door fees to the association. So for every door in that community, the cable company will actually pay a fund into the association, which can be beneficial to that given budget year. But it also reduces costs significantly for the residents, right? So while association assessments may be going up, what are ways in which the association can help bring down other resident costs? And cable programming could be one of those that could be extremely lucrative. And then I think another thing that most all could do would be to take a look at energy audits. Where are we spending? What utility costs are impacting the association directly? Are there programs out there? Are there grants? Do we use our energy auditors to come through and just see if there's opportunities for reducing usage, reduce, reuse, recycle? Looking at things on that. Might be smaller depending on the size of the association, but are definitely things that could help to trim dollars where we're looking to trim. And I think it also speaks to the credibility of your management company, as well as the credibility of the board, who's looking far and wide, not just getting hyper-focused on specific cost within the budget, but what are other ways that we can mitigate assessment increases?
So what about issuing more covenant violations and fines? What do you think about that?
That is certainly a way to drive revenue, maybe not popularity, but certainly you could drive that. Look, I would never encourage boards to use violations as a revenue source, right? That should really, the big thing there is about community appearance. And again, educating a community that the more we all collectively take care of our association, the more everybody's home values go up. So probably wouldn't be my first go-to on to try to drive more violation assessments.
I would agree with that. All right, Amy. So what if a board goes through all of this and in the end they end up needing to raise dues? Or yeah, how do you feel like they should handle that?
And so hopefully if you've been listening and you've heard throughout this process that more than likely you are going to be raising dues, right? Just the costs of all services have gone up incrementally. So most of our communities most communities across the South are going to be expecting to raise dues. And it really does come down to educating homeowners. So transparency cannot be overstated. It is so important. What we find often happens at this stage in the process is that people start to get a little bit nervous, right? Okay, hey, we're going to see dues go up by $50 a month or whatever that number looks like relative to their community. And how do we manage that message? And the answer is early, often, right? You're going to want to manage that message and create multiple modes of communication to share and help homeowners understand what is happening. So communication is going to be critical in this process. We'll hear some board members say, hey, we kind of want to wait until we've got everything wrapped up. We've got all of the exact numbers. We know everything's been ticked and tied before we start to share that information. And our advice would be, hey, you don't have to know everything. You can start early and say, hey, we'd like to give you guys some updates in the direction that things are going. Here's what we're starting to see as we go through this process. We do expect more information to come. Our goal is to make sure that homeowners, you are informed early and you are informed often. And when you lead with that, homeowners can say, okay, we see the direction, we have a better understanding. We can start to ask questions, and that will give our team members or the boards at communities, if we're not managing your community, insight into what homeowners' concerns are and how you can best answer those questions. If you go right to answer their questions, that helps to satiate what some of those concerns are, and you can certainly lead the narrative. So don't wait until the very last minute ahead of adoption meeting to say, hey, here's what you can expect and here's why. You're going to want to do that earlier. And again, it varies by your community. If you're a small community, you've got 12 homes, maybe communication looks a little different for you. But if you are a large community, several hundred homes or greater, you're going to want to make sure that you've got plans, set aside time to send something in writing, to hold potentially town halls or open workshops so that people are aware and have access to get the answers that they're looking for.
Yeah, it's great advice, Amy. And again, I want to go back to, again, the board meetings and the budget adoption meetings and planning sessions that I've been sitting through. Again, I'm hearing a much more informed resident base, at least informed to the standpoint of, I have expectations of my community, especially in the condo and high-rise world, where many people bought because of the type of experience that the building offered when it was new, right? Might be luxury, might be ultra luxury. And while, again, over time, people were maybe appreciative that we made decisions that kept assessments down in that given year, people are appreciative right up until the moment that their building no longer looks the same. It doesn't feel the same. It's not performing the same. It doesn't look as nice as it used to be, and or we've diminished service over time to the point that it's no longer luxury. So again, look, property management's a balancing act, right? In every sense of the word. And while there is always lots of emotion that does come to the board members that they've got to grapple with, right? With people not wanting assessments to go up, having those well-honed conversations around investment, right? What we're doing to invest, helping people to understand the decisions we make here, how that will compound throughout the years. And unfortunately, where those who are, again, having the greatest heartburn this year are those that have made decisions. I've got a community that reduced assessments 2 years back in the 08-09 crash, actually reduced reserves and then did not increase reserves for 6-7 years, and now are finding themselves in a situation of those past decisions coming to haunt and trying to figure out how to backfill those reserves, and also now in Florida having to deal with the structural integrity mandate coming through. So kicking the can is only as good as until that can hits a wall and it can't go any further. And so again, doing the right thing, again, just can't be overstated, and taking and educating residents on where we are making good decisions.
And so a question may be, what about if you have board meetings and no one ever attends your board meetings? Well, I mean, Amy answered one of those is send it in writing, send something in writing that explains the budget and what you are seeing from a budgetary standpoint. But another idea is to actually record your meetings and then send a link so that your residents can view the recording. There's no excuse for them now. They have all of the information at their fingertips that they can go and look and hear how you're communicating with them. We've heard solve for what's right, do what's right. It's no different in communication. It's the right thing to do, to communicate openly, honestly, and transparently with your residents. I mean, they've entrusted you as board members to do the right thing for your association, not hide behind fear of repercussions. So
I think same message for our operators out there, right? Our property managers that are on here today, right? Your boards are looking for your strength and your expertise. It's not the easiest thing to stand up in front of a group and tell them what's happening with the budget, but it's our obligation. And those who are most successful are ones who just truly embrace that, stand beside their boards, and deliver great messages. Sorry, Amy.
No, just to build onto that, when you think about communications, I mentioned it earlier, but I'm hoping that it sticks, is that you should really be considering the mode of communication. So certainly one method is, in today's day and age, insufficient, right? So if you always send emails, that might not be the way that the bulk of your community, or maybe even some of your homeowners, appreciate receiving that message. So standard forms include text message, voice message, email, and certainly you have access to social media if that's part of what you use in your community as a way to keep your community updated. And then of course your website, which is a static place of resource for homeowners to be able to get information. So those are all ways that you're going to want to consider how to share updates, as well as naturally your board meetings and live town halls. So consider what you're taking advantage of and how to fold that into your overall budget timeline to ensure people stay up to speed and informed.
good stuff. All right, so I think we are finished with our Q&A, but we have some time here for some questions from the audience. Brent, Amy, you ready for that?
Sure.
All
Sure.
right. So let's start with the first one. We're going back to the wages and payroll and all those. So one question we got is, how do you recommend handling bonuses? And then a second follow-up to that is, how do you handle giving the staff a bonus funded directly by the owners? Any suggestions there?
Yeah, so I'm happy to take it. So certainly the recommendation from our team is to make sure that you're set. In today's competitive wage environment, most people who are at a salary rate are expecting an annual bonus. And so you're going to want to make sure that that's part of your plan, that you don't just have wages baked in there, that you have bonuses baked in there. That really does, the federal government requires that wages and bonuses go through payroll. And so we would certainly advise not to circumvent. That could have tax implications for your team members, as well as potential issues for your association. So would recommend that budget bonuses are budgeted for and they're part of your annual plan.
And bonuses should be performance-based as much as possible. Best way to do it is to determine some metrics or accomplishments that you'd like to see your team make in order for them to receive a bonus or a percentage. All right, so
to build off of that, just before you move on to the next question, yeah, look, board members do not want to put themselves in a situation where they're quasi-employers. So they don't want to be ranking performance of team members. They may share their perspective with their team members' leadership team to say maybe things that they've noticed, but they don't want to actually rank the performance directly. They'll want to, again, share what their perspectives are to their boss or their leader, and then that could be part of the annual performance review. But absolutely in all cases, bonuses should be tied to specific performance metrics that are handed by the supervisor.
All right, next question. Going to the reserves and structural reserves. Who or how determines what would be considered as a structural reserve?
Well, that's a little bit still of things we're all learning, right? This is brand new. We have companies out there who have been specially licensed to do the structural integrity reserves. It's pretty straightforward from what types of items need to be in there. Still learning how that gets applied community by community. So it was the state who determined what are those general items that must be included in a structural integrity reserve, and things you would imagine would be the building envelope, primarily looking at things like some of the core electrical and plumbing items. The great news is for communities that have been reserving in their regular reserves, many of those things may have already been included and money has been saved. And so as part of the structural reserve, those funds can come over into the structural reserve section, and communities won't have as big of a hit if they've been, again, kicking the can on their other reserves as it comes in. So the state determined what general items go into that, and you have people writing structural integrity reserve inspections, right? Writing those out. And there's a lot of dialogue going on now. Attorneys, CPAs, these specialists in reserves. I think it's going to take a couple of years probably to sort through it all and really determine what is ultimately going to be in there. But it was founded based upon the unfortunate situation in Southeast Florida, in which the building was not maintained at a structural level because there weren't the funds to maintain it. And that's what drove the decision on what went into the general categories.
Now, Brent, wouldn't you say, though, that the advice to property managers in the industry and board members that they shouldn't try to figure that out on their own or wait for those things to flush out through time? The ask today is lean into your reserve study. You should have a professional reserve study that was prepared by somebody who that's what they do. And they should have updated the reserve or given you a new study that says these are considered structural and that's what you plan to. So I would really avoid getting into manager, what do you think? Hey, board member, what do you think? No. Use that plan directly and then use that as you go forward. That's the best way to mitigate liability to the association and maybe avoid misdirection.
And avoid risk to the board members themselves.
Exactly right.
A lot of great questions here. This is an interesting one. What is your opinion regarding special assessments versus dues to help build for reserve expenses?
I'd love to take the first swing at that one. I'm pretty passionate about this one. Those who know me, special assessments, in my opinion, should be the absolute last decision ever made. And there's several reasons for it. Look, nothing can take the place of wise budgeting, right? Taking the time, understanding what are the costs in front of us. To Amy's point, it's never, while they're never going to be perfect and you can't wait forever to get all kind of data in, it should be the best estimation of the true cost to operate the association in the coming year. And as well as reserves, how it's going to be maintained over multiple years, right? Looking at our reserve study. So special assessments are truly intended to be for something that was completely unforeseen. Knowing that insurance costs are likely to go up, wages are likely to go up by $1 here in Florida, those are foreseeable. There's a lot of data that supports it. And so those should be budgeted for, not to the point it's like, well, let's go ahead and take the risk. And if it does happen, then we'll go ahead and do a special assessment. Special assessment is, again, typically one of the last things we'd want to do, because even if an association finds that maybe the budget wasn't quite right, we get a third or maybe halfway through the year and we find out that there were items that are going up, but they don't need to be paid for immediately. I don't need the cash today, but we need to start collecting to pay increased costs. Then you can do an amended budget, right? And there's rules. You have to look at your governing docs, work with your CPA and your attorney, of course, as always. But you can amend that budget and increase, or in some cases, if you had a chance to decrease, not likely, but increase your assessments for the remainder of that year in order to compensate for what wasn't there. A special assessment would be typically something catastrophic, right? A repair that wasn't foreseen, a storm hits, not something that was foreseeable. That's when you do a special assessment. Look, to me, the biggest downside of a special assessment in my mind is that it sends a message that perhaps as leadership, as the association, we don't necessarily know what we're doing. We don't know how to budget. We're not being thoughtful. The impact to the individual homeowner, again, if this is about driving value for homeowners, right? And board members are homeowners too. We want our home to continue to appreciate. When you have a special assessment in place, that is a mark on the record, right? When somebody goes to sell their home, that special assessment is a marker on there, again, of, just raises a trust question of whether the association is being run correctly. And the last thing is, it costs money. Special assessment takes additional cost, right? Additional dollars from association coffers to actually manage that special assessment. Attorneys' costs, accounting management costs. It's just, I am very much not a fan of special assessments. We've had to use special assessments more in the past 2 years than ever before because of maybe some of the surprises in insurance and some other emergency repair costs following storms. But again, they should be absolutely the last ditch. I'll step down off my soapbox.
And let's see here. What do you recommend regarding, this is interesting, increasing capital contributions for new homeowners in order to increase HOA revenue?
Look, at the end of the day, it will still be a cost to the community. I do think that comes with a certain amount of risk. So we've seen home sales reduce over the last several years. And so just keep that in mind, that that's a variable cost. It also stops point of entry, could potentially be an impact point of entry. So that's really a property by property evaluation, but you cannot depend on that revenue like you can depend on monthly assessments. And the volume on new homeowners, since it's smaller, will be a greater cost delta difference than it would be across an entire homeowner population. So I would suggest looking at that property by property.
All right, let's see here. And then let's see, last question here. Do you have any suggestions about collecting dues from owners who are significantly behind?
Well, that, again, default here is this is certainly something to be discussed with association counsel, right? And following your documents for what your docs allow. But again, I think it comes back to communication. A lot of times we'll see, unfortunately, people end up delinquent and they weren't even aware. They weren't aware that they were delinquent. There's an assessment change that hits in January. People have their ClickPay account or however they tend to pay, maybe from their bank. They've got an auto payment set up. I confess I don't log into my association all the time and check to see if something's changed. So I set it and forget it. And unfortunately, people find themselves down the road in arrears and they weren't even aware. So I think great managers are ones who take a look at delinquencies on a frequent basis and make courtesy calls, right, to make sure, see if somebody needs help with correcting how their account was set up, et cetera, from there. I do see, as we do get into true delinquencies and as things go to attorneys, I've seen board members, if their docs allow, look at getting into payment plans. The goal is obviously to get people to pay, not to chase them out of their homes or to take over their home or their condominium association. So I think, again, doing the right thing is, remember, add humanity into all of the things we do. How do we help people be successful and make payments? I don't think anybody ever wakes up in the morning thinking about how they're going to not pay their assessment, right? That's certainly not the intention. So what are steps that the board can take to be benevolent, but also administer rules equally across for everybody, right? Again, to mitigate risk for the association and you as a board member.
Well, that's all the time that we have for today. Brent, Amy, thank you so much for sharing your expertise and insights with us. One of the key takeaways for me is that the budget season does not need to be challenging. It takes thoughtful, realistic planning and open communication to have a successful season. For anyone who's asked a question that we've not answered, our team will be sure to get back to you. To our attendees, thank you for joining us for Effective Strategies for Mastering Your 2025 Association Budget. We hope you found the information helpful and that you find ways to take what you've learned and put it to work in your community. Have a great rest of your day.
Thank you.